San Francisco, the once poster child of tech innovation and the previous juggernaut in the commercial real estate market, is now puzzling market analysis, investors, and business owners. And I have some data points that are going to provide a very dark illustration of this new reality. And they serve as a foundation for a conversation not just about numbers, but trying to understand the current economic state of San Francisco, the impact that it'll have on banks, and also other cities. So before we jump in, don't forget to hit that like and subscribe button to stay informed in this very fast-changing market, and a simple click is all it takes, and I really appreciate your support. All right, so let's dive in. Now, some of the numbers that are causing ripple effects across the Bay Area include a building on 115 Sansome, and it stands as a case study for a broader market issue. Once valued at $83 million, it's now being auctioned for a mere $25 million, a figure that has created a $53 million outstanding debt problem for the bank. And it doesn't stop here. This is not an outlier, but a symptom of a market where buildings are selling for insane discounts in San Francisco. Don't believe me? All right, let's check out another. 123 Townsend Street, across from the Giants Stadium, 138,000 square feet, was supposed to be occupied by PayPal until September 2029, but Rubicon Point purchased it in October recently for $72 million, which is a 49% discount on what it cost in 2020. All right, another. How about 600 Townsend Street? 87,000 square feet. Salesforce occupied the building previously. LBA Realty sold the property in 2012 for $47 million with a 10-year lease to Salesforce. Later, LBA purchased it back vacant and in September sold for $25 million. All right, how about another? 550 California Street. 355,000 square feet, now fully vacant. Pennsylvania Land and Capital purchased it in September for $40 million, which is a 62% discount less than the price Wells Fargo paid for it in 2005. And this part, I'll show you some images of others. And the list goes on, and it goes on, and on, and on. Okay. I think you're starting to get the point. This isn't just a matter of market dynamics, but a reflection of a deeper change in the business ethos. The pandemic has rewritten the playbook, with companies, big and small, rethinking the need for physical office space. The shift towards remote work has not just been a temporary blip, but it has been something that now we are dealing with on a day-to-day basis. For cities like San Francisco, where operational expenses could spike 15 to 20% just to bring teams back into offices, the question isn't about affordability, it's about necessity. And the harsh reality is, if there's a fiscal cliff that San Francisco is inching towards, with budget shortfalls projected to hit $1.3 billion in the coming years, the city's response likely will be to increase borrowing. And that's just a band-aid solution that could lead to a debt-laden future. It's a precarious balancing act between maintaining city services and fostering an environment where businesses can thrive. But let's not view this just through a single lens. The counter-argument to the doomsday narrative is that this could be an opportunity for recalibration. The decline in property values could attract new businesses, those that were previously priced out, leading a diversification in the city's economic base. Moreover, the reduction in costs could lead to a renaissance of sorts for startups and small businesses, which have historically been the lifeline and lifeblood for innovation. Okay, so what about the banks? How are they playing? Well, the banks, the silent players in this unfolding situation, with significant exposure to commercial real estate, institutions like Bank of America have to confront the reality of impaired loans. Yet, there's a reluctance to recognize these losses, perhaps out of fear of triggering a wider financial impact. This resistance to face the music isn't just a financial strategy, it's a psychological standoff with the market's new norm. There's also some broader economic implications for cities like San Francisco that need to be considered. The city's fiscal challenge are not unique, but also exacerbated by its high cost of living and doing business. The potential for increased borrowing to cover budget shortfalls is a double-edged sword, providing short-term relief but potentially saddling future generations of debt. And a spiraling debt that a city is already having difficulty coming to terms with, the narrative is clear. the commercial real estate market in San Francisco is at a crossroads. Now, the city, once a magnet for tech giants and startups, is grappling with this identity in the wake of a shifting corporate culture. The value proposition of a San Francisco address is being weighed against the benefit of a distributed workforce and the appeal of more economic viable cities. To put it simple, San Francisco is no longer being seen as the commercial hub for tech innovation. Companies are leaving, and they are leaving while taking major losses. But this means we can take insight from the situation as we are witnessing a market in the midst of a correction. The commercial real estate sector of San Francisco, once a symbol of prosperity, is now a case study in adaptation. As the city navigates this fiscal challenge and businesses reassess their spatial needs, the market will find new equilibrium. This could be a momentary downturn or a fundamental shift in the urban economic landscape. The outcome will depend on a complex interplay of market forces, regulatory response, and the evolving nature of work. The only certainty is that change is happening, and its ripples will be felt far beyond the city and the Bay. Thanks so much for watching. If you've gained value out of this analysis, please like and subscribe to ensure that you're staying up to date with the latest content. And until next time, stay informed and navigate these shifting financial tides with confidence. Thanks.